Listen up. If you are still refreshing your brokerage app every 5 minutes hoping for a moon mission on February 25th, 2026, you have already failed the IQ test of this market. You are currently being groomed as the exit liquidity for the largest circular financing scheme in human history. The mainstream media is hallucinating over a $650 billion AI capex cycle, celebrating the build-out like it's a permanent gold rush. But while they celebrate, they are ignoring the depreciation clocks ticking in the basement of every hyperscaler. We are exactly 11 days out from NVIDIA's Q4 FY26 earnings call, and the sleight of hand has never been more obvious. While retail investors are staring at the revenue top line, the smart money is staring at the fire exit.
Let's dissect the numbers the mainstream is too compromised or too stupid to touch. Microsoft, Meta, and Alphabet have collectively committed to a $650 billion spend on AI infrastructure for this fiscal year alone. The official narrative calls this a growth investment. I am telling you it is a survival tax. From a technical perspective, these aren't assets. They are liabilities with cooling fans. The silicon cycle for an H100 or a B200 isn't measured in years. It's measured in months before the next Rubin architecture makes your existing $40,000 chip look like a glorified paperweight. When the depreciation curve is steeper than the enterprise adoption curve, you don't have a business. You have a furnace burning investor cash just to maintain a stock multiple.
Here is the actual mechanism of the robbery. Big tech borrows cheap capital or uses cash reserves to buy chips from NVIDIA at a 75% gross margin. NVIDIA records this as record revenue, beating the consensus estimate. The stock pops, and you buy the top based on a forward PE ratio that assumes the cycle is infinite. But ask yourself the only question that matters. Where is the consumer revenue to justify the $650 billion hole? ChatGPT Plus and Gemini Pro subscriptions are rounding errors in this equation. The sleight of hand is simple. They are moving money from one pocket of the tech oligopoly to another, creating a velocity of money that mimics growth but is actually just circular capital rotation. You are the one left holding the bag when the hardware hits 50% depreciation in 18 months. Look at the physical data from early 2026. Data center power consumption in the Northern Virginia corridor alone has surged 22% year over year. This isn't just a stat, it's a hard physical ceiling. The power grid cannot scale at the speed of software. We are hitting thermodynamic limits that no scaling law can magically fix. When the grid hits capacity, that $650 billion in hardware sits idle, bleeding value every second it isn't running an inference load. It's a game of musical chairs played with nuclear power plants, and the music stops when the depreciation expenses finally crush the net income in the back half of 2026.
D11. February 25th is not a celebration for the bulls. It is a day of reckoning for the deluded. NVIDIA is expected to post revenue nearing $65 billion, but that is a lagging indicator of past enterprise hysteria, not a leading indicator of future sanity. The real leading indicators are the rising cost of capital and the absolute saturation of enterprise inferencing capacity. They want you to focus on the Rubin roadmap to keep you in the seat. They want you to dream about 2027 while they dump their 2026 allocations into your buy orders. I am here to show you the exit before the fire alarm rings.
Let's talk about the hard reality that no CEO wants to discuss on an earnings call. The market is pricing NVIDIA based on the assumption that the H100 and the upcoming B200 Blackwell chips are long-term infrastructure assets, like building a bridge or a dam. That is a lie. These are not bridges, they are melting ice cubes. The thermal design power, or TDP, of a B200 rack is pushing 120 kilowatts. Do you understand what that means? We are no longer limited by how many chips NVIDIA can print. We are limited by how much heat we can remove before the physics of the data center collapses. The sleight of hand here is selling you a scaling law that ignores the laws of thermodynamics. When you have to build liquid cooling infrastructure just to keep your asset from melting, your CapEx efficiency doesn't scale linearly, it crashes exponentially. Now, look at the depreciation schedule. This is where the wealth transfer happens. In the traditional cloud era, an Intel CPU server had a useful economic life of 4 to 5 years. In the AI era, the useful life of a GPU is effectively 18 months. Why? Because NVIDIA's own roadmap is the weapon that kills its customers' ROI. The moment the Blackwell B200 hits the racks in volume later this 2026, the spot price for H100 compute, which Meta and Microsoft spent billions accumulating, will collapse by 40 to 60%. This is planned obsolescence on a trillion-dollar scale. Big tech is spending $650 billion on hardware that will be technically obsolete before they have even finished writing the depreciation checks. They are burning furniture to keep the house warm, and they are calling it growth.
Let's follow the money to the unit economics of inference. The cost to train a frontier model like GPT-5 or Llama 4 is estimated to be north of $2 billion in pure compute. But the revenue model is stuck in a race to the bottom. We are seeing a 70% price compression in API costs year over year. Think about that. The input costs, NVIDIA hardware, are staying astronomically high due to monopoly pricing, while the output pricing, API tokens, is collapsing due to open source competition from Meta. This is the definition of a bad business model. You have the most expensive supply chain in history feeding into a deflationary consumer product. The only winner in this equation is the shovel seller, NVIDIA, while the gold miners, big tech, are digging their own graves with diamond-encrusted shovels.
The grid premium isn't free. Utilities are now demanding upfront capital commitments for power delivery. This means big tech isn't just paying for GPUs, they are paying for substations, transmission lines, and nuclear power purchase agreements. This hidden capex is not fully priced into the operating margins yet. When Amazon or Microsoft has to pay a 40% premium for green energy just to run a cluster that loses money on every query, the operating leverage story breaks. The narrative of software margins is dead. We are returning to heavy industry margins, but the stock prices are still trading at SaaS multiples. That gap is the crash zone.
Finally, look at the insider selling. While Jensen Huang talks about the industrial revolution of AI, look at who is selling. It's not just retail taking profits, it's the insiders and the early whales. They know that the $650 billion capex wall is a pull forward of demand from 2027 and 2028. We are eating the future demand today. Once the training clusters are built, you don't need to rebuild them every year, unless the model performance jumps 10x. But we are seeing diminishing returns in model performance. If GPT-5 isn't 10x better than GPT-4, the justification for the next $100 billion cluster evaporates overnight. And when that order book thins out, NVIDIA stock doesn't just correct, it re-rates to a hardware cyclical. And that re-rating is a 50% haircut from here.
So, who is the real victim of this $650 billion heist? It isn't Microsoft or Meta. They have cash piles that can burn for a decade without a scratch. The victim is the retail investor buying the AI ETF at all-time highs. The sleight of hand is complete. The insiders have sold their shares into your liquidity, transferring the risk of the depreciation cycle from their balance sheets to your retirement account. The party is over, but they are still selling tickets at the door.
Here is your strategy for D11. On February 25th, when NVIDIA drops the numbers, do not look at the revenue beat. That is a distraction. Look at the guidance. If there is even a 1% deceleration in the sequential growth rate, or a hint of margin compression due to HBM3E yield issues, the algorithm will trigger a liquidation event. The smart money isn't betting on the build-out anymore. They are betting on the bottleneck. Watch the power grid. Watch the cooling costs. Watch the insider selling volume.
This market is unforgiving, and I don't want you to face it alone. We dig deeper than the headlines here, because your portfolio depends on it. If you found value in this analysis and want to stay ahead of the curve, please consider subscribing. Let's navigate this volatility together. Thank you for watching.